We usually just give everyone a few minutes to jump on.
Great.
Shall I turn my video off as well?
I think
It's up to you.
keep it on for the moment, and then when I'll
When you go into the
yeah, and I'll hand over to you initially to say hello, and then I will take over.
Hi everyone.
I see a familiar face in Bola, who's here, which is great. Yes. Great to see you, not to see you, but to have you here.
Again, I don't have a huge amount of admin to announce this time round. Other than if you haven't seen the climate tech session, which was meant to take place 2 weeks ago, it's now going to be on the 29th, which that's next Friday. So that's going to be with Heidi from Pale Blue Dot, and we will share details next week so that you can join. It's going to be Friday lunchtime, so that will now be our last session rather than next Tuesday, which would have been the original last session. So apologies for changing things around a bit there, but you should also be able to catch up on other recordings, which should be up on Notion now. As mentioned, we're putting a couple of recordings up from the summer and from the US cohort as well. Please bear with us. We had a couple of technical issues, but they're getting up and you should be able to have access to them hopefully this week at some point. As usual, it takes a little while for the recording to come through, so give it a day. If you see it and it's not working, come back, and hopefully it will have loaded. I think that's kind of the only admin we have by this point. We're 2 months in. You know how to, you know the drill. You know how this runs. I'm going to give people another couple of minutes, or actually, yeah, give another couple of minutes.
I'm happy to start, and people can filter in because I'll probably just be doing preamble,
catch up,
which is fairly boring.
Yeah.
But
yeah, let's do that. Well then, hand over then to Check and Dan from Ada Ventures, who I will let you both introduce yourselves properly. They're going to be here to talk about how to raise a fund.
Amazing, thank you, Julia. And before I start, I'm going to just hand over to Dan to quickly introduce himself before I begin.
Hi everybody, my name's Dan and I'm part of the Ada team. I'm an analyst and I'm going to be working at Ada for the next 6 months, and I'm here during this conversation to help you all with all your questions. So if you have any questions, please write them in the chat and I'll do my best to answer them.
Amazing, thank you, Dan. So what I'm going to do is talk to you all about raising a fund, and this is a topic kind of close to my heart, and obviously something that when you're starting out in VC, you don't need to know about, but it is quite useful to sort of have an understanding of how it works, raising a fund, so that in the future, if that does, ever come on your radar, you know about the mechanics of it, you know about the ways to do it. It's super cool for me to be here talking to you again. I am one of the co-founders of Diversity VC. At the beginning of the year, I handed over the CEO role to Laddie and Daisy. So it's kind of nice to be back in front of the future VCs and just talking to you. So yeah, thank you for having me. And I hope you find the session useful. I'm going to share my screen, which is going to be sharing some slides, and I'm going to share a video as well. So hopefully you can all see this okay. So Ada Ventures, this talk is all about raising a fund, and it is part of the Future VC program. So what I'm going to talk to you about today is just introducing myself. I'm going to talk about Ada Ventures. I'm going to talk a bit about privilege and fundraising. I'm going to show you a video of our fundraise. And then I'm going to talk about some of the tips and tricks around what you need to think about before embarking on raising a fund, what investors are looking for, some of the sort of mechanics of fundraising, and hopefully answer any questions that you have as well. So some background on me. So I am one of the 2 founding partners of a fund called Ada Ventures. Before joining Ada Ventures, I have spent the last about 8 years working in VC. I was previously at a fund called Downing Ventures. I've also worked at a fund called Techstars, and also Seraphim Capital. As I mentioned, I co-founded Diversity VC with Lillian and Travis about 6 years ago now, and I'm now on the board. And I started my career actually in advertising, which is pretty unusual, and not a route into VC I would necessarily recommend to any of you, but it does prove that I think the whole point of Diversity VC is that different perspectives make for great investors. And I think that having started in advertising, it's actually given me a really interesting insight into analyzing companies. And I think it takes all sorts of different people from all sorts of different backgrounds to make a great VC. And I started my kind of academic career. I studied English literature before going into advertising. So again, I didn't have a traditional finance background. I think if there's anyone on this call or part of the Future VC program who's thinking, I don't have the right background for VC, take heart from, there's lots of different stories. Some of the top VCs globally, including, Benedict Evans from Andreessen Horowitz, now he's independent, but Mike Moritz, Rebecca Caden, they were all journalists actually before they went into VC. So you really don't have to have a cookie cutter background. And in fact, I would say it's an advantage. So Ada Ventures, what is Ada Ventures? Ada Ventures is a fund that's named after this amazing woman called Ada Lovelace. So Ada Ventures' mission is all about finding extraordinary talent in places that other people aren't looking. We are trying to find the Ada Lovelaces of today. It's a £38 million fund. We invest at seed and pre-seed stage, which I know you all already know about because you've been on this course now for the last 2 months. So I'm not going to go into any of that. And the reason why we look for extraordinary talent is because we believe that will drive great returns for our investors. So despite the fact that some of what we do drives positive societal impact, actually the core reason we do it is because we believe it is the way to generate great returns for our investors. So some previous investments and co-investors that we have invested with before are just on this slide. You may know some of them. And yeah, I thought really I would start this talk by showing you this video that myself and my partner Matt made while we were fundraising, because I think it's the best way to really describe the whole experience of 18 months of going around the world trying to raise money for this fund. So I'm going to play this video and then I will come back to you to unpack some of the things that come up in it. And apologies for the very amateur quality of this video because it was made on a complete shoestring when we had no money. So here we go. Hopefully you will all be able to hear this okay. What are you working on?
These are our notes, 48 pages of notes that we take when we meet LPs or people that are just kind enough to help us. We're now going to take yet more notes and put them into yet another version of the pitch deck.
We're on day 3, but we just had a call with 50 South Capital, which is a very, very old bank in Chicago, and we were discussing kind of this process of staying alive and how it's so important just to basically stay in the game with these LPs. I think as the week's gone on, we've really got into some of the people that are a bit more our people. Just today, we've had 2 really exciting meetings of people who I think, you know, they could be small checks, but actually they could be really brilliant, supportive people who are going to kind of help us raise our game.
This is where they keep all the money check. Bought my bag, ready to be filled up. I think that's how it works, raising a venture fund, right? Just go to where the money is and ask nicely. Make sure you bring a big enough bag. And they fill it up, right? And we go and invest it in these amazing companies. Checo. Here we are, part 2 of our global travel on a shoestring. Welcome to New York now, and then we go to Boston tomorrow. We have a day in New York on Tuesday. We go to Philly on Wednesday, a day in New York on Thursday, fly back overnight Thursday. So it's whistle stop, it's shoestring, but it's going to be successful. Here's to it.
And why are you wearing a shirt that matches the tablecloth?
Yeah, I didn't think that through really, did I? First time in Louisville. It's a great day. We had bourbon for lunch. They were just a joy. The family office component, obviously, very rich principals that invests in deep tech companies and also has an LP strategy on the side. So who knew? I think the biggest thing was that we decided to go to take the risk to fly down here for the day on a little bit of a whim, but it was absolutely 100% the right thing to do. But as you know, Checo, when we travel, we try to be as local as we can. We're here to meet some amazing female principals who hopefully will want to invest in our fund, and we're super excited to be here. And I've just noticed your earrings that you're wearing, which are radical. Which glamorous location are you in today?
Just in San Francisco, California.
Oh yeah, let me just check that out. Oh yeah, totes.
3rd meeting with the British Business Bank.
Hurrah, go for it.
Very exciting.
Go get him, old Mother Hubbard. Check out how you feel.
Great.
Let's do it.
So that was our video of our fundraise. So let me just go back to sharing my screen. Hang on a second. So I'm going to try and pick up quite a few of the themes that we touched on in that video. So the first thing to say is that your partnership is incredibly important. And that is the biggest thing that investors are really digging into is, do you work well together? They're making a 10-year commitment, if you know, at a bare minimum, because the fund's life is about 10 years. And they really want to know that the partnership is not going to fall apart over the course of that 10 years. The biggest risk to them is that the team doesn't stay together. So you really have to show that you are good at working together, are good at investing together. Ideally, you have a joint track record. Matt and I were pretty fortunate in this because we had previously worked together. He was actually my boss, and we had left our previous firm together to start this new firm, this new fund. And so we had a joint track record where we'd invested together over the course of 3 years. And that was the thing that a lot of the investors were really interrogating and digging into, was how much do I believe in this partnership staying together? And one of the big decisions that we made early on was that we decided to be 50-50 partners. And that was something that a lot of funds, you know, don't talk about because it's quite a kind of confidential subject and something that people don't really want to disclose, is what's the economic split between the partnership. And we were advised by an investor that the best possible way to set yourself up for success was actually to be equal partners, because then you don't have any of that issue of one person getting the economics, the other person resenting it, and that creating a kind of rift, which then splits up the partnership over time. More recently, you're seeing more solo capitalists, people who are just saying, actually, I don't want to take the risk of having a partner. I just want to be on my own. And limited partners previously were pretty reticent to invest in solo GPs, but they're becoming more and more comfortable with that, because the risk of a partnership collapse is so big that they'd rather just bet on one person. So the partnership is the crucial thing if you're thinking about raising a fund. The number one thing to get right. We did personality tests to analyze if we actually work well together. We spend a huge amount of time just talking through all these key issues, as you do when you become co-founders. And that really set us up for success when we're having all these kind of conversations with investors. The second point that comes up in that video is this point about portfolio construction. So this is a chart that is a kind of screenshot of a whiteboard, and it shows how we were thinking about building the portfolio in the fund. Because when you go to investors and you talk about what you're doing, the first question I'll ask is, what is the fund size and why? Why does that fund size make sense for your strategy? And because you're probably all amazing students of VC, you know a lot of the information that's out there about the number of companies that you need to sort of give yourself the highest likelihood of hitting a winner, and all the different like Monte Carlo models that people have used, and the angel list data, and the Kima Ventures data, and the Horsley Bridge data. It's fair to say there's lots of different points of view on how many companies are the right number of companies for a fund to, at seed stage or Series A stage, get the highest probability of having a winner in that group and returning capital. And we were doing lots of experimenting with that in terms of our fund size, our check size, our follow-on ratio, and all of these calculations, which we then had to put into a fund model. And this diagram shows you how we're thinking about it. So at the bottom, we've got these kind of 400K checks buying kind of 15 to 20%, of which 7 of them we were going to follow on in. And then over here, we have sort of 8 new investments at the higher check size, and then we're following on into 7 at Series A. So that shows you sort of the portfolio construction that we'll be describing to LPs. And I can go into that in a bit more detail if anyone wants to understand that more. I think the third thing in this video that really comes through is that it's a numbers game. Fundraising is, for any company, a really hard thing to go through and requires talking to a lot of people, kissing a lot of frogs. Many of them won't be the right investors for you. In our case, that was particularly true because there's so few people that wanted at that time to invest in European venture. So unfortunately for the climate carbon footprint, we had to fly around the whole world to try to find investors that wanted to speak to us about this. And we ended up taking notes on every single meeting. So we had sort of hundreds of meetings, and we ended up writing basically a novel worth of notes because we had to remember what everyone said at each of these different meetings. And that's what led us to, writing all of these notes. And I think it just kind of illustrates just quite how time-consuming a process it is to raise a fund. And then I think the final point that's really critical when you're trying to fundraise for your own venture fund is to be different. When we spoke to a lot of investors, their perspective was, well, we're already invested in Local Globe, or we're already invested in another seed fund. Why would we want to invest in you as well? And many of these investors are spending most of their time across other asset classes. They might be doing hedge funds, they might have a multi-asset portfolio, might do some equity, some property, and they're spending about less than 5% of their time looking at venture capital in general. Then you come in and you're talking about pre-seed and seed and all these different sort of niche things about VC. And actually, they just think of, well, we've already got a VC. Why would we need another VC in our portfolio? So we needed to land in the first kind of couple of minutes of the meeting why Ada was different and why they should pay attention to us. And And I think that is quite often something that people raising new funds sort of miss and don't spend enough time on. They just come out with a fairly generic strategy. And I think that's the biggest reason why they don't get traction with LPs. So on that note, these are two slides that come from our, hang on, where's the other one? There. These are two slides that come from our investment deck. And what I've included them here because what they do is just illustrate why we're different, why Ada Ventures should be taken seriously and why you should look at it. Our model is about inclusive venture. It's about finding talent where others aren't looking. And the way we do that is we have this big scouting network, which now has nearly 100 people across the UK in all sorts of different communities. And we incentivize those people through an upfront cash fee and also a share of the profit on the fund, the carry, if they find a company that we invest in. And that is very different. There's not many funds that have these kind of scouting networks, certainly not with this inclusive focus. And that's what we spend time talking to LPs about, because that we found as being the key thing that they wanted to dig into around differentiation. And then we brought it to life for them with a second slide where we talk about what our brand is, and then the evidence for that we now have, because we've now raised the fund and we are up and running, which was more difficult when we first started because we were saying, this is all the things we're going to do, but we had no evidence to say that we could actually do it. So we now have kind of the evidence of saying, actually, we've now made 2 investments that have come straight through our website. We've now made 4 investments that have come through the scouting network. So we're validating that this is not only something that we're doing, which is different, but also it's working to drive high quality referrals to us. So I think this is a really important point, and something that I always really want to talk about if ever I'm talking about raising a fund, which is privilege. And I wrote an article after we closed the fund, which maybe Dan can find and post in the chat in case you haven't seen it, all about kind of fundraising and privilege. And it's particularly true when it comes to venture capital funds because of this concept of skin in the game, which I can see there's been a kind of question about, which is this idea of the GP commits, the GP capital commitments. Limited partners, investors in funds want to see that the investors, the GPs, general partners, are putting in capital to the fund alongside theirs. And that's one part of the privilege equation. But there's also a whole other picture, which is, in my case, my parents sent me to private school. I was able to go to a school which sent about 50% of the year to Oxbridge. Obviously, absolutely massive leg up to get into Oxbridge, which then led to lots of different career opportunities, network. I was able to get into venture via, networking, and I spent 6 months trying to find a way to meet someone who worked in VC. And I did end up meeting my now partner, Matt, and he, gave me a job ultimately. Obviously, I had to do all the interviews and everything else, but I was able to find that connection, not through a job board, but through that personal connection. So all of that privilege, that's the sort of starting point before we even get to raising a fund. All of that privilege kind of enabled me to do was then get a job in VC and then learn all aspects of VC. So because I worked in a new firm, I was exposed, I was just one of 2 people in the team. I was exposed to everything from sourcing to analyzing to executing, structuring, legals, post-investment work, portfolio management in a short space of time. And that is what enabled me to have enough of a track record to ultimately, after 2.5 years, really hardly any time, go out into the world and with Matt, go and raise a fund. And then there was the question of how did we afford to raise a fund? Because we needed to pay for FCA regulation, we needed to pay for lawyers, we needed to pay for our own costs. For 18 months, it took us 17 months to fundraise. And then the GP commit, which I mentioned, which is typically 1% of the value of the fund. So on a £30 million fund, that is £300,000 between myself and Matt. So that is a huge amount of money. You sort of don't put it in as one lump sum. It goes in over the course of several years, but still, having that first £50,000 each to put in as a lump sum at the close of the fund is just a massive, massive ask, which most people don't have access to. So it's very problematic. And that's why I've written that article and I'm actually trying to kind of campaign to change it. To answer the question in the Q&A, yes, there are some different structures to paying for that GP commit, for sort of conveying to investors that actually you are really committed to raising the fund, and it's not just you're taking other people's money and you don't really have that personal sort of skin in the game. And one of the ways that I've seen people do it is through salary sacrifice. So taking a much lower salary in order to fund it. I've also seen LPs who just say, look, share your bank statements and tell us how much money you have, and then we'll work something out which is still meaningful for you, but is not the sort of typical 1%. So, I hope that is changing, but I think it's a really important thing to highlight. So just back to Ada Ventures. This is just some statistics of the fund. We had our AGM last week, so I thought I'd just pull that out here so you can see the sorts of things that we're now doing. Now we've raised our first fund and we're going to be coming on now to raising fund 2 already. So the process of fundraising is kind of constant. It never really stops. You have to, if you're a founder, you have to keep those relationships going, because investors invest in lines, not dots. They want to see a sort of trajectory of progress, as opposed to you coming in and then coming in again after a year and then saying, no, now we want money. They want to see how you're delivering and executing on the strategy that you said you would do. And these are some of our portfolio company founders. So we've talked a little bit about this already, but just as a refresher, and I think you've done a session on this already, so I won't go into this in too much detail, but just the economics of a VC fund. So how it works is you have this sort of 2% annual management fee, which is the money that you use to run the business. And then you have 20% carried interest, which is the profit on the capital. So on a 30 million fund, that's about £600,000 a year in management fees, but you only get that for the investment period, which is typically the first of 2 to 3 years. And, that money has to cover absolutely everything in terms of your cost base. The carried interest is the bit that the sort of reason why people raise small funds. So the carried interest is paid on the invested capital, which means that you need to do even better on that money, because you net off the fees and then you only get the carry on the invested capital. So it's, I think, just putting out here that it is really tough to raise, to return really good results on a venture fund. I think most venture funds, if you look at the data over the course of the last 10 years, particularly in the UK, people have not returned, more than sort of 1 to 2x in general. And it's only really the top quartile or even the top decile that has returned 3x plus. That is changing. And there are some incredible funds coming out of Europe now that have returned sort of 10x or even 15x on the entire fund, which is obviously a huge, fantastic result for the investors, but also for the GPs. So I'm just outlining here the economics. I've simplified it all, but just so you can start to see that if you are able to raise your own fund, it is really, financially incentivizing to do it if you can actually generate the returns on the fund. So these are just some questions that we talked about when we were fundraising, before we went out fundraising, that we had to have really good answers to. One of the kind of more nuanced questions is about, will you lead rounds? A lot of investors want to back people who are prepared to price rounds and lead rounds, set valuations and lead the legals. And that is something that not all funds do. Some funds just say, well, we'll follow it on after Index or Excel. And that tends to not be quite such a good strategy because you end up getting kind of squeezed out. So you have to validate or demonstrate that you can actually lead deals quite often. I think the other thing here is about founders picking you. The best founders pick their investors. So you have to have a really clear answer for why founders are going to choose you. So track record, we've touched on. It is a really key area of diligence that the investors spend a lot of time on. Like, they want to see every single company that you've invested in before. They want to see what your role was. They want to see how you sourced it. They want to see, were you on the board? And they go through that in minute detail because they want to know if you're actually good at this. And that's why quite often limited partners look for teams that have come out of existing firms, because they're able to then understand and reference, like, what was that person like in that firm, which makes it even more difficult for people who come from unknown backgrounds or new funds or new firms. So that is one of the areas that you'll definitely need to work on if you're thinking about raising a fund. Typically, it's very hard to raise a fund if you're a completely new manager without any track record, particularly if you don't have any track record with the partner that you're raising that fund with, which contributes to a lack of diversity in the whole network. And again, this is something that I think is really problematic, and I've spoken to LPs about before, is that quite often the way that they do due diligence is they call the managers they're already invested in. So if you're not in that kind of little niche network, then you won't get good references from those people. And what we did before we raised the fund ADA was we spent time being based at Balderson's office, and we spent time speaking to all the other fund managers that we could, who could vouch for us and who could talk to LPs about us, and sort of say that we'd shown them good deals and that we were good investors. So, and some of the terms you might hear bandied around is TVPI, total value to paid in capital. So that's a metric that LPs look at to say, are you good, according to all of the data that we see across other funds, like what's your TVPI of your investment so far, and is it in the top decile or top quartile? And then DPI is distributions. That's actually cash returned as opposed to just the value of the investments. And that's, again, a key kind of metric that investors will be looking for when they're evaluating your pitch. So this is about making investments while fundraising. So one of the big philosophies that Matt and I had throughout raising ADA was about acting as if and being a fund manager before we had a fund. So we used to joke that, if we went to an office every day and we were sort of doing work from 8 till 7, but we didn't get paid, was that still a job? And it was. I mean, we made investments, we did investment committees, we had deal flow meetings every Monday morning, and we just acted as if we had a fund before we had a fund. And the way that we did that is we did something called SPV investing, which is special purpose vehicle investing. So what that was we met companies, and if we decided to make an investment, went through the whole due diligence process with them. And actually, Bola's company, who's here, was one of the investments we made, which is Pradina. And once we had decided we wanted to invest in that company, we then went to a group of investors and we said to them, look, this is an opportunity. You can invest effectively through us in that company. We will structure it, we will lead the legals, we will price it, and we will manage that investment for you. And through that, we were able to invest about £2.2 million across these companies. And that enabled us to show good investment opportunities to investors and to demonstrate that we had this capacity to source great investments and to bring to life our strategy. So that's something I always advise aspiring fund managers to think about doing, is can you invest before your fund is closed? And that ended up being a really good thing as well, because this company at the bottom here, Habu, actually became our first investment when we closed the fund. Because we knew them already, we were tracking them, we were able to build a relationship. And then as soon as we closed the fund, we were able to invest in their seed round. They've now gone on to raise Series B. And that is a kind of, looks like it could be a kind of big winner within our portfolio. So that was a very good thing that we did. And I would definitely recommend that to other people. So I think I sort of touched on this, but again, this is a sort of philosophy that Matt and I had while we were doing the fundraise, which was that we embraced the no's. We actually really loved the no's, because the no's brought us closer to getting to yes. And, you know, I think one thing I'd really urge people to do is, before thinking about setting up a fund or starting, you know, to raise a fund, is that you need to enjoy the journey and you need to enjoy fundraising, because it is such a big part of, you know, being a VC. And so we had this more positive outlook on getting a no, that it would get us closer to the ultimate yeses that we needed. This is this concept and term that you might hear, which is about having an anchor investor for a fund. So your anchor investor for a VC fund is typically your sort of lead investor if you're a company. They help you to structure, and they kind of lead on negotiating the limited partnership agreement, which is the main document that governs a fund. And they will also, you know, potentially help you get other investors alongside them. For us, we went through a process with the British Business Bank, which is this bank for the UK, which addresses equity gaps. And they have a program called the Enterprise Capital Fund, which is for fund managers that are new. And we were very kind of pleased to be chosen as part of that program. And they have about 92 applications, or 90 plus applications a year, and they pick 1 to 2. So it was extremely competitive to get that. But what that ended up meaning is that they invested sort of over 50% of the capital that we needed for the fund. And they helped us with making sure that we were structuring everything correctly and giving us advice along the way. And that, I think if we hadn't had that, we would have had to have a different investor, a different LP that was doing that role for us. So, you know, fundraising, it never stops. As I say, we're now looking to raise fund 2. We're going back to a lot of the people that we spoke to for the first time in 2018. We've kept them updated. We've been writing newsletters, and we've sort of been in touch with them at least quarterly since then. And typically LPs know funds for sort of 2 to 3 years before they end up investing. So it's really important that you keep the lines of communication open, and just constantly keep reinforcing that this is what we said we would do, and we are now doing it. That's the thing that LPs kind of want to know the most. And they are, you know, they tend to be very long-term people. So they're just not going to make a commitment to you in this first 6 months. They're going to want to know you for several years before they make that commitment. So that is all I was going to say about raising a fund, but I wanted to open it up now to questions from all of you, in case you want to dive into any of the areas that I've mentioned here. You can see that there's a couple of questions in the Q&A as well, which I will ask. So we've talked about the different structuring for the GP commit. How did myself and my partner finance your expenses towards raising the fund, personal savings? Yeah, so it was a combination of different things. We actually both went into debt to fund some of it. We both also did some consulting work, so we were able to cover some of our living expenses and day-to-day expenses. And then we did also have some personal savings. I was able to do some work for my parents' company, also doing some consulting, which was useful in that it helped me with having extra money. but yeah, it was a real combination of different things. Like Matt kind of remortgaged his house, and he's really still, now paying off that debt. So it's a really big risk to take, and you have to get your whole family to buy into it, I guess, as well as you, because quite often you're relying on the people around you to support you financially whilst you're doing that fundraise. So how do we decide what kind of companies we wanted to invest in through Ada? It's a really good question. And actually, it's not something we've really talked about much in terms of the investment strategy, which you have to, again, outline to LPs when they're asking you about your fund strategy. And it's a big part of your deck. Some funds take the approach of going very vertical specific, so they're to say, we're just a gaming fund, or we're just a metaverse fund, or we're just a cybersecurity fund. And I think in many ways that's a very much easier proposition for LPs to get their heads around, because they can say, well, okay, I've already got a prop tech fund, I've got a fintech fund, I need a cybersecurity fund, and then they can, possibly invest in some of the companies that then come through that directly, all those different funds. With us, we decided not to do a sector specific fund, because what we were trying to say was that there are all these pockets of kind of underserved customers across all these different areas, and they don't just fall into fintech or prop tech or insurtech or whatever it might be. So that was one thing we decided to do, is stay quite broad. We also looked at a lot of the data of great funds in terms of great returning funds, looking at the US in particular, and many of them were not sector specific and actually did have a broad strategy. So that was also important for us. And the types of companies, we knew we wanted to invest in tech. So we needed to see that companies had this kind of massive leverage opportunity that they could, ultimately reach 1 billion people. We didn't want to invest in companies that just grew in a linear way. And that's really important to the whole sort of returns model of venture capital, that you have this power law effect where some of your companies can get very, very big, very, very quickly. So tech was really important. And then we kind of made a decision very early on that we only wanted to invest in companies that had positive societal benefit. And what that means is, when we look at companies, when we assess pitch decks, when we write our investment papers, we're trying to interrogate what are the positive societal benefits, what are the potential risks of this company if something were to, go wrong, or if this company if you took it to its extreme, what are the things that could impact society negatively. So that meant that we decided, we're never going to invest in companies doing, building things that contribute to obesity or to climate change, or to building weapons or anything like that. So hopefully that sort of answers your question. If you look at our portfolio page, you can see some of the companies that we've invested in across, broadly kind of consumer, healthcare, and future of work are the 3 sort of broad themes that we look at. So I think I've answered that one. Is there another question in the chat? No. Perfect. So happy to answer any other questions if anyone has any. I don't think they do, which is great. Well, hopefully that means that. Oh, here we go. Challenging part about fundraising. Dan has some questions. Okay, I will go to Dan's questions first, and then I'll come back to Diana. So what do I wish I knew if we were starting out again? I think, God, that's a good question. I think probably to have a bit more confidence and self-belief in our strategy, and kind of the fact that we could dictate things to investors as much as they could dictate things to us. I think it's easy to feel on the back foot and to feel like you're kind of going in with your sort of begging bowl saying, here, give me money. But actually we should have had more belief in, this is a fantastic proposition to those investors, and actually they should want to invest in it. So I think I would have had more confidence, and I would have been more proactive and on the front foot. I think ultimately we realized that we needed to inject momentum into the process right at the end. And we ended up running an AGM before we had closed the fund. And that meant that we brought to life for a lot of the investors, like what we were doing. And they allowed them to meet some of our founders and allowed them to sort of see some of the other potential investors in the fund. And that gave us a real kind of boost of momentum, which got a lot of people over the line because they were just kind of waiting on the sidelines to see if this was really going to happen. And the other thing that we did was we actually set a deadline around announcing the fund at TechCrunch Disrupt in December 2019. And that was actually a key thing because it got a lot of people over the line. So I try and do that again. I try and kind of like create a forcing function of a deadline in order that I could get those LPs to actually commit and just not stay on the sidelines. What's next for Ada? Well, we're raising Fund 2. It's going to be probably bigger than Fund 1. It's going to be investing in another sort of 30 to 40 companies across similar sort of themes to the ones I've mentioned today. We are going to also be growing our team, and we're going to be trying to grow our presence across the UK, so doing more events in places that most VCs don't go to. So really excited about doing more of that. And then how do we become part of the Scout community? So there is a form on our website which you can complete, where we've now had about 300 applications from people who run communities that are underrepresented in tech and VC. And you can just fill in that form and we will get back to you to see if you're a good fit for the Scout network. We are typically looking for filling gaps as opposed to just anyone, because we've got quite a lot of representation in different groups. So if we don't have representation in that group, that's what we're particularly looking for. And again, you can see that on the website. So I'm just coming back to Diana's questions. So what was the most challenging part about fundraising? I think it was probably staying resilient to all of the no's and just the self-doubt, because you get told that you're not going to get through, or that it's not going to be a fit by all these incredibly smart, incredibly successful, incredibly knowledgeable people, and you somehow have to stay positive, and you have to stay having that self-belief in your strategy and why it's going to be successful. And often you're also like a pretty low point because you don't have any real validation from anyone, because you haven't been able to start yet. So I think that staying strong in the face of a lot of rejection was pretty tough. But again, it goes back to the real advantages of having a partner. And then the next question about describe the early days of leaving Downing and starting my own fund. Was it awkward in any way? Were we cautious about potentially poaching LPs? Yes, it was extremely awkward. And it's a much longer story, which I can't go into here, but I would not advise it. And were we cautious about potentially poaching LPs? We weren't, just because of the structure of Downing, which was a retail investor fund. So there were no sort of institutional LPs that would come into a fund like Ada. So it was a very different set of people that we'd be talking to. But I think, we were certainly cautious, and we wanted to make sure that we left on as good terms as possible. But it's always difficult when people leave firms and they start their own thing. There's always a sense of, well, why aren't you doing it here? And, could we have done anything differently? So, the early days, I think, of leaving Downing were very, very difficult. It was a lot of self-doubt. It was a lot of questioning of, were we doing the right thing? Was it not better to stay in a job which paid us well? And yeah, I think it was something that taught me a lot about myself, and I probably wouldn't have done it were it not for Matt and his kind of more risk forward attitude, which I've always struggled with more than him. Did I have any mentors helping us along our journey? Yes, we did. And actually we made a really intentional decision early on to appoint a board of steering group members, which comprised of 4 different people. One of them was a very experienced LP. One of them was a lawyer who we'd known for a long time. One of them was a fund manager, and one of them was a Series A fund investor. And we meet with those people quarterly, and we just can take them any issues that we have, anything that comes up, any questions, and they are super valuable in giving us input, giving us advice. So they were mentors. And then I also have various other mentors who I have built relationships with over time. And I'd really suggest doing that. I think it's always a difficult thing to ask someone straight out, will you just be my mentor? You've got to build a relationship and get to know people first. And then over time, hopefully, when you have a good enough relationship, they'll agree to being your mentor. And I've done that with a couple of people. And I think the key to mentors is just finding a shared, some sort of shared values or shared interests. And then that's how you can actually start building a relationship, which hopefully will lead to mentorship. The next question is about expanding the scope beyond the UK of the Scouting Network. So at the moment, and this is partly back to having the British Business Bank as our core lead investor, we just invest in companies that have a UK presence. But we do actually have scouts that are beyond the UK, because we always like to have kind of eyes and ears in other places, and particularly people who have some kind of relationship to the UK where they can still refer founders from the UK. So we have scouts in the US, in Oslo, in Germany, in Netherlands, Sweden. So we're very open to that. So I would definitely apply on the form if you think that that could be something you're interested in, and then we will have a look at it and get back to you. So the next question is about the second fund. Has the process changed given many other VCs are continuing to launch new funds aimed at different stages, i.e. series of investors creating seed funds, increasing competition? Yeah, you probably saw that Greylock launched a 500 million seed fund, I think it was. Andreessen's got a massive seed fund now. There is a lot more competition. And has that changed our process? Yeah, I think it means that we have to be even more clear on what our differentiation is, and why we're different. And ideally kind of give examples of when we have won deals at the margins against some of those names. We are a pre-seed and seed fund, which means we invest at the even earlier stage than seed, so more like 500k rounds. And at that stage, you don't have so many crossover investors reaching down into investing at pre-seed. So that gives us some advantage. But it also means that for us, we have to raise a slightly bigger fund than we had first time round, because we have to be able to compete with these funds that have massive deep pockets in these seed rounds. So that has definitely changed our process, and something that we have to explain to investors. So hopefully that's answered a lot of your questions. But I know we're almost kind of also out of time. But thank you so much for all those questions. And you know where to find me if you have further ones that we didn't get to today. I'm just check at adaventures.com. You can find me on LinkedIn, you can find me on Twitter. And there's quite a lot of information also about us on our website as well. So yes, hopefully that was interesting and useful.
Thanks so much, Czech. And yeah, we are now sort of just out of time, but thank you so much for joining. Everyone, as usual, we've got details and we'll share the slides afterwards, so you should be able to, I think there were some details on there as well, so you'll be able to know how to get hold of Check if you've got any other questions. Would also recommend following Check on Medium, Twitter, LinkedIn, all the socials. There's always going to be some interesting reading on there. So thanks again for joining. Thank you to all participants for joining as well. And yeah, see you all on Thursday for the next session.
Cool. Thank you, Julia. Thank you, everyone. Enjoy the rest of the sessions. Please make the most of the program. I don't think I would get into VC if I started now. So it's a tough industry to break into, but this program is an amazing way to get into it. And so, yeah, do make the most of it, and also connect with one another as well, because you're going to have a brilliant peer group just with this group that you've got here. So yeah, thank you again, and good luck for the final bit of the program.